The market does not end in a whisper. It ends in a roar of public applause right before the stage collapses. The final leg of a great bull market is the most dangerous, for it is designed to attract the greatest number of speculators and then systematically drain them of their capital. Everyone believes they are a genius, that the old rules no longer apply. This is the precise moment when the rules matter most. The signs of the end are always there, printed on the tape for anyone to see, yet ignored by the masses who are blinded by greed and easy profits. I documented these signals, learned through financial ruin and incredible success, in my book, Reminiscences of a Stock Operator. You can find the link in the description of this video to understand the full scope of this unforgiving game, but today I will give you the essential truth about how to see the end before it arrives. It is a lesson in market breadth, a concept as simple as counting soldiers on a battlefield. I remember 1929. The air itself felt electric with money. Chauffeurs, bellhops, and shoeshine boys were all dispensing stock tips. They weren't just buying stocks, they were connoisseurs discussing the merits of radio versus Montgomery Ward. When the public becomes an expert, the professional must become a skeptic. My office was an island of silence in this storm of euphoria. I had no radio, no news ticker blaring headlines. My only connection to the market was the simple glass ticker globe, spilling out the endless ribbon of tape. That tape was my world. It told me the price, the volume, and most importantly, the truth. And the truth it told in those final months was deeply unsettling. The headlines screamed of new highs in the Dow Jones Industrial Average, what you would call the S&P 500 or the NASDAQ today. The great industrial generals, U.S. Steel, General Electric, American Telephone, were marching forward, flags flying. On the surface, the bull market was stronger than ever. But my eyes were not on the generals. They were on the army. The thousands of other stocks, the foot soldiers that make up the true body of the market. And what I saw terrified me. While the averages were making new highs, the number of individual stocks making new highs was shrinking each day. This is the great divergence, the first and most critical warning sign of a market top. For every general planting a new flag on a hilltop, 10 soldiers were falling back, wounded and exhausted. The public doesn't see this. They read the headline, "Market hits all-time high." They see the famous names they know and trust pushing upward, and they assume everything is fine. They pour their life savings into the market at the very peak of its strength, not realizing that the foundation is crumbling beneath them. I would sit for hours watching the tape, doing a simple mental calculation. A stock in the average would push up a point. In a healthy market, dozens of other stocks in its group, the sister stocks, should follow. A strong move in a railroad leader should see buying across the whole railroad sector. But that wasn't happening. U.S. Steel would advance, but a dozen smaller steel companies would do nothing, or even sag. It was as if the generals had lost their command. Their orders to advance were being ignored by an army that was too tired to continue the fight. This is market breadth. It is the measure of participation. When participation narrows to just a handful of famous names, the bull market is a hollow shell. It is a beautiful facade with nothing but dry rot behind the walls. Then came the second sign, the character of the volume. Volume is the energy of the market. It shows the force behind a move. In a healthy uptrend, volume expands as prices rise and contracts as prices pull back. It shows enthusiasm for the advance and a lack of interest in selling. In 1929, I saw the exact opposite. On days when the averages pushed to new highs, the volume was anemic. It was public buying, small, hopeful orders chasing the last bit of profit. There was no institutional force behind it, no conviction. But on days when the market dipped, even slightly, the tape would run wild. Volume would explode. This was heavy, urgent selling. It was the insiders, the well-informed operators, using the public's buying enthusiasm as a gigantic pool of liquidity to unload their holdings. They were selling into strength, feeding their shares to the clamoring crowd who were desperate to buy the very top. This is called distribution. It is the quiet, methodical transfer of stock from strong, informed hands to weak, emotional hands. When you see new highs on low volume and pullbacks on high volume, you are not witnessing a bull market. You are witnessing a well-orchestrated exit. My conviction grew. I began to test my theory. The greatest mistake a speculator can make is to try and short the strongest stock, the market leader. That stock is the last to fall. Trying to short it is like standing in front of the lead locomotive. Instead, I looked for the weakest soldiers in the weakest regiments. I identified the industry groups that had stopped rising months ago. Within those groups, I found the stocks that could not even rally on the strongest market days. They were waterlogged. I began to sell them short, in small amounts at first. The reaction was immediate. They did not fight back. They simply collapsed. It was like pushing on a door that was already unlatched. This confirmed everything. The internal structure of the market was rotten. The generals might still be standing on the hill, but their army was in full retreat and a rout was inevitable. The final piece of the puzzle was the behavior of the leaders themselves. A stock that had been a pillar of the bull market, one that had risen hundreds of percent, would suddenly have a day of enormous volume, churning through hundreds of thousands of shares, yet close the day unchanged or even down slightly. The public sees this and thinks, what a fight. The buyers are holding the line. They are mistaken. What they are witnessing is the final act of distribution. The insiders are dumping the last of their massive holdings, and it takes every ounce of public buying power just to keep the stock from collapsing under the weight of the selling. This churning action at the absolute highs is the market's final, desperate signal that the game is over. The smart money is completely out, and only the hopeful public remains to hold the bag. When I saw this in several of the key market leaders in September of 1929, I was no longer a bear in theory. I was a bear, in fact, and I began to sell the market short with all my conviction. The rest is history. This is not a story from a bygone era. The names of the stocks change, the technology of the ticker is different, but human nature and the character of the market remain identical. Greed, fear, hope, and ignorance drive the cycles, just as they did a century ago. Your job as a speculator is not to guess, not to hope, not to listen to the experts on television. Your job is to read the facts as they are printed on the tape and act accordingly without emotion. You must learn to diagnose the market's health by looking beyond the headlines. Therefore, you must adopt an unbreakable system for analyzing market breadth to protect yourself from the inevitable crash that follows every great speculative mania. This is not a suggestion. It is a command for your financial survival. First, you must obey the law of divergence. Never trust a new high in the major indexes unless it is confirmed by broad participation. In your modern terms, this means watching the advanced decline line. If the S&P 500 makes a new high but the line showing the number of advancing stocks minus declining stocks fails to make a new high, a serious divergence is in place. The generals are advancing alone. They are walking into an ambush. This is a signal to stop buying immediately and begin raising cash. Do not argue with it, do not rationalize it. Accept it as a primary warning sign. Second, you must obey the law of faltering leadership. The stocks that led the bull market are your canaries in the coal mine. They have the most profits for insiders to protect and will therefore be the first to be distributed. Watch them with extreme prejudice. When a former high flyer that has been impervious to bad news suddenly drops 10% on a massive volume spike, it is not a buying opportunity. It is a fire alarm. When another leader fails to make a new high with the general market and rolls over, it is another alarm. When 2 or 3 of these leaders break down, the bull market is officially on life support. The public will tell you these are healthy corrections and a chance to buy the dip. They are wrong. These are the first cracks in the dam. Third, you must obey the law of volume's character. Price can be manipulated in the short term, but volume tells the truth over time. Turn off the news and study your volume charts. Is the market advancing to new highs on volume that is lighter than the previous upwave? This is a sign of exhaustion. Are the down days, the pullbacks, occurring on volume that is heavier than the up days? This is a sign of distribution. Is the market churning at the highs with massive volume bars that produce no upward price progress? This is the final signal that supply has overwhelmed demand. Treat volume not as a secondary indicator, but as a primary confirmation of the market's true intent. Price is the headline. Volume is the story. Fourth, you must obey the law of laggard breakdown. Just as I did in 1929, you must periodically test the market's structural integrity. Identify the weakest sectors and the weakest stocks within them. Are they holding their key support levels, or are they beginning to break down while the averages are still high? If the weakest links in the chain are snapping one by one, the entire chain is about to fail. Do not make the mistake of buying these laggards because they look cheap. They are cheap for a reason. The smart money wants nothing to do with them. Their weakness is not an opportunity for you to be a hero. It is a profound warning about the health of the entire market. The public looks at the market as a single entity, the Dow or the S&P. The speculator sees it for what it is, a vast army of individual stocks. An army's strength is not determined by the fame of its generals, but by the health and morale of its soldiers. When the soldiers are tired, wounded, and beginning to desert the field, it does not matter how bravely the generals wave their swords. The battle is already lost. Your job is to see this before the final rout begins. By watching for divergence, for faltering leaders, for the character of volume, and for breaking laggards, you can do more than just predict a crash. You can protect your capital, step aside from the carnage, and preserve your resources to act when the panic is over and the next great opportunity presents itself. The public sees the ticker symbol. The professional sees the army. Learn to count the soldiers. Your survival depends on it.